Good morning. Nice to see you all. I'm one of a number of Richard's former PhD students who's here. I can count at least 5 others around the room. Richard was a tremendous mentor to many of us. I think I can say Richard would have been very excited by the lineup of speakers and topics over the next few days, and we'll miss him as we do, but this is an excellent tribute. Green College is of course the perfect location for a symposium inspired by Richard's work, because he considered building up the college through its early years one of his most important achievements. I remember Richard and Diana arriving here in the fall of 1993 with Richard as a founding principal, and Richard calmly dealing with the fact that the residents were turning up even as the college was still very much under construction. The topic of the symposium also flows perfectly from Richard's work. It could be argued that the central focus of Richard's work sort of throughout his career was the institutional production of knowledge, firstly about crime, and then more broadly about risk and security. Janet's instructed me to wave this book about, called Crime, Institutional Knowledge and Power, The Rich Criminological Legacy of Richard Erickson, which is an edited collection of some of his greatest hits. It was very hard to narrow his vast body of work down to something that could fit in one volume, but there's more information about it in the conference materials. And what I'm going to talk about today very much flows from Richard's work. I'm going to be talking about the grand theorist Ulrich Beck and the ongoing debate about what Beck calls his insurance principle. And so it fits with the symposium theme because it deals in part with the ability of institutions to know and calculate risk, and it carries on a debate that Richard himself and I began with Beck a number of years ago. So, as many of you know, Beck argues that we live in a new kind of world, a new world that's taken shape since the 1970s, which Beck calls second modernity. And one thing that marks this new world is new human-made risks, new manufactured risks, global risks that cross borders, interact with one another in complex ways, and these new manufactured risks present a fundamental challenge for existing institutions, for science and technology. So risks to do with new technologies like genetic engineering, with major environmental accidents, climate change, terrorism, information technology risks like computer viruses. And for Beck, the key defining characteristic of these new risks, in fact, what Beck says is the key indicator of this shift to second modernity, is that unlike the old risks, these new risks are beyond the capability of the insurance industry to calculate and manage. So these new manufactured risks are uninsurable. Okay, and so there are problems with both the calculability and the scale of these new risks. Now, in one way, Beck was onto something very important because he was recognizing the hidden but central importance of insurance in the contemporary world. So this is one thing that I and others found exciting, something that Richard and myself, and also other people in the room right now, like Tom Baker and Jonathan Simon and Pat O'Malley, were trying to spotlight the neglected centrality of insurance. But in other ways, we had difficulties with this insurance principle. And so Richard and I published an article back in 2004 trying to test Beck's argument. And we used the example of the insurance industry's situation after 9/11. So 9/11 at the time was the largest single event insured loss in history, although since then Hurricane Katrina was 3 times as costly. But 9/11 was the biggest to that point, and broadly what we found was that although 9/11 seemed to be precisely the kind of risk Beck was talking about, the insurance industry actually adapted and functioned reasonably well after 9/11, both to cover the claims of over $30 billion and then working in kind of quite an uneasy partnership with the American government to continue to offer terrorism insurance coverage, at least in many cases. So we have to qualify this. There were all kinds of difficulties. The industry required a massive amount of government support through something called the Terrorism Risk Insurance Act, and terrorism insurance was very expensive, especially to commercial clients. But on the whole, one can argue that the insurance industry still functioned reasonably well. And so we use this example of 9/11 to suggest that on this particular point about insurance and uninsurability, Beck is simply empirically wrong. So more recently, this debate has continued, and Beck spent a number of pages in his 2009 book, World at Risk, responding to this previous article that Richard and I wrote, and introducing a revised form of his argument. And so now I want to zero in on a key element of Beck's response. And so just to quote from this book, he's revised the argument somewhat. So what he says now is the absence of adequate private insurance protection is the, and he put this in italics for emphasis, the indicator of the transition to the uncontrollable risk society of second modernity. So the insurance industry no longer functions without help. So there's a new emphasis in this book on the point that it's private insurance, the insurance industry, that no longer works, and now the insurance industry needs the government to step in and prop it up. Okay, so, and this is the #1 indicator that the contemporary world, second modernity, is spiraling out of control. Okay, and so Beck has turned our argument back on itself and argued that what we described as something that discounted his argument was actually demonstrating the argument, because the expansion, as he put it, the expansion of risk outstrips insurance protection. Insurance protection loses its function of neutralizing fear at both the social and political level, and free-floating fears are being set free, which are open to political instrumentalization by all kinds of actors and groups. So there's different kinds of responses one could make to this. I think the last quote, I'm just not sure how emotionally invested people are in general in insurance. That's one kind of place I would start. But I'm not going to develop that. What I want to do today is simply to consider Beck's premise that there was adequate private insurance for catastrophes before this new era. And so what I want to suggest in response to Beck is simply that things were always like this. In other words, the insurance industry's hold on such human-made catastrophe risks has always been pretty limited, and the government's often been involved as a kind of backup, insurer of last resort in this uneasy partnership. Okay, and as a premise to this, I want to talk about this distinction between human-made and natural risks. So I want us to think about the example of earthquakes for a minute. And I want to use this example of earthquakes to suggest that always been human-made catastrophe risks that were very difficult to calculate and control, but companies still nevertheless have sold insurance for them. Okay, and people could say, what? Earthquakes are not a human-made risk. Earthquakes are a natural disaster. And Beck is talking about these new human-made risks. So the first move is to problematize this distinction. You can consider one of the biggest catastrophes of the 1990s, the earthquake in Kobe, Japan in 1995. Out of the 5,470 people that died in Kobe, 90% of the people were killed by collapsing roofs. So being crushed to death by a cheaply made department store collapsing in an earthquake is anything but natural. Were Hurricane Katrina or the events around the recent earthquake and tsunami in Japan simply natural disasters? Clearly not. As an American Congressional Committee observed in 1966, floods are an act of God. Flood damages result from human acts. So, the failure of technology to manage earthquake risk would likely cause many of the same questions, the same crisis of faith as the so-called manufactured risks that Beck is talking about. Why couldn't we predict the earthquake? Why didn't we make our buildings better? Why didn't earthquake insurance work better? But earthquake risks are certainly not new. And of course this goes to the question of the knowability or calculability of risks. Okay, Beck says new manufactured risks are very difficult to calculate effectively, but numerous scholars have demonstrated that insurance companies actually have long insured various risks, even when the companies did not have dependable probabilistic data. Low probability, high magnitude catastrophes, such as earthquakes, are at the opposite end of a spectrum from high frequency risks distributed in a large population that lend themselves to actuarial calculation. The science of earthquakes has long been very weak concerning both when, where, and how frequently earthquakes will occur and the size of the loss. Okay. As the CEO of one company that sells earthquake insurance said in an interview, I mean, you might as well blindfold yourself and get dizzy before you throw a dart in terms of picking a number. So at the same time, insurance companies have a variety of institutionalized mechanisms for dealing with risk in the absence of such data. And Andrew Collier wrote a very good article in Economy and Society about how insurers proceed with modeling or enactment of catastrophes in the absence of this kind of actuarial data. Okay, and of course, you can point to Beck thinking about the reality of risk in a different way from us. So Beck has an emphasis kind of focusing on the real nature of risk, whereas I and others are focusing on the institutional production of knowledge about risk. I would argue that it's a difference in degree, not in kind. But okay, anyway, earthquakes have also historically long strained the capacities of the insurance industry in the same ways Beck has attributed to the so-called new risks. So the insurance industry's long struggled to provide adequate earthquake coverage. Insurers have been reluctant to enter earthquake markets or fled such markets after catastrophic losses. And insurance companies have also often insured earthquakes and other risks that were so big there was no way the companies could pay. Okay, so in broad strokes, the financing of low probability, high magnitude risks involves very long-term budgeting. Many insurance companies over the years simply gamble rather than budget. Okay, so this is a big empirical claim, which I'm still gathering support for, but I can give some striking examples. If we look at the situation in the 1990s here in Vancouver, if there had been a catastrophic earthquake, which is that such an earthquake is often in the consciousness of people who live in Vancouver. If there had been such a catastrophic earthquake, numerous companies which had significant earthquake exposure would not have been able to pay their policyholders. Okay, so many insurance companies, instead of paying up, would simply have folded. These may be companies which you now have earthquake insurance with, but this was apparently long the case in the insurance industry in British Columbia and elsewhere. There were, of course, financing arrangements in place. There was reinsurance, and there was a compensation scheme whereby solvent companies would band together to pay off policyholders and so on. But even so, it was estimated that a catastrophic earthquake here in Vancouver could cost $10 billion, and the industry only had financing in place to cover $3 billion to $4 billion. So there'd be another $6 billion that wouldn't be paid. Okay, and as one insurance executive here in Vancouver, whose company sold a lot of commercial earthquake coverage, put it bluntly, well, if I really thought we were going to have an earthquake, I wouldn't live here. This insurance executive was speaking in a high-rise office building in downtown Vancouver, not that far from the Sylvia Hotel, actually. And he said, we were in this building, and he said, we looked at this building and we decided it's probably going to sway and snap off at the 15th floor, but we haven't moved. And then he went on to note, if a major quake happens in Vancouver, it's probably going to fry the industry. Okay, so you're thinking, well, this is just sort of isolated, sort of local example, but I've got a report from the United States in 1992 saying the same thing. So let me quote this American report. We can expect a number of insolvencies to come out of a catastrophic earthquake, and insolvent insurers would not just be those involved with earthquake claims. They would include some large diversified national companies, so not just earthquake claims would not get paid all over the country. Other kinds of claims, automobile, workers' compensation, and fire would not get paid. So that's from the American National Research Council Committee on Earthquake Engineering. Okay, so you're saying this is fairly recent history, and so this just reinforces Beck's claim that these risks are now outrunning the ability of the insurance industry to cover them. Okay, well, I want to go back a bit more than 100 years ago to the 1906 San Francisco earthquake and fire. So at that time, 12 insurance companies went bankrupt. Okay, so if you look historically at another so-called natural catastrophe with a lot of social human factors from 100 years ago, the San Francisco earthquake of 1906, in which about 3,000 people died and 80% of the city was destroyed, the situation is very similar. So, to give just one example, a lot of residents in San Francisco did not have earthquake insurance, but they had fire insurance. And so many San Francisco residents actually set their homes on fire after the quake to collect damages. And actually the fire following the quake, for various reasons, was much more destructive than the earthquake itself. But the point is that even back in 1906, the San Francisco earthquake was a human-made catastrophe, sort of bound up with modernity, modern society, first modernity getting out of control. So Beck argues in this book that private insurance has now been hollowed out in the same way that the state has been hollowed out. And Beck has also said that insurers now feign control over the uncontrollable. So, and I would respond that if you look at the example of earthquakes, it becomes clear that at a certain level, the industry has always been hollow, has always faked control over the uncontrollable. In the book, Beck calls the insurance industry a Potemkin village, a fake cardboard cutout of the real thing. I would just say that's always been a key characteristic of insurance, that it makes promises that sometimes or often it can't keep, and in times of crisis or catastrophe, insurance reaches its limits. Government has for a long time been the insurer of last resort for catastrophic risks, various kinds of moral hazard problems associated with it. As David Moss observes and documents at length in his book, when all else fails, government as the ultimate risk manager, deep government involvement in the management of catastrophe risks is really nothing new in the United States, despite the country's reputed commitment to laissez-faire. Okay, so just to briefly conclude, this is certainly not fatal by any means to the whole of Beck's theorizing about second modernity, as the rest of his theorizing is not logically bound up with or dependent on this one point, the insurance principle. Hence, it's always seemed very peculiar to me that he positions this and sort of overtly repeats that this is the foremost empirical test of his theory, because it's not logically interconnected to the rest of it, and it's also relatively easy to debunk empirically. Perhaps the most straightforward thing to do when we are debating this question of uninsurability is just to go and ask people in the industry this very question. So reinsurance, as some of you know, is this hidden world of very large-scale companies that provide backup insurance to insurers. And if there's a major catastrophe, the risk is passed on by insurers to massive reinsurance companies like Munich Reinsurance. And Beck is from and lives in Munich. So people at Munich Reinsurance are very aware of his proclamations of doom about the insurance industry. And so just several months ago, I had the opportunity to speak to people at Munich Reinsurance about Beck, and to quote one high-ranking person there, Munich Reinsurance's position is that there is no fundamental problem with insurability. One response you could then make is, well, of course, a reinsurance company is going to say that, because otherwise they'd be putting themselves out of business. Fair enough, but it's always been like this. So the insurance industry's always confronted a challenging risk environment in an uneasy partnership with the government, and it does its best to survive and profit in conditions of limited knowledge, but acts like it has the knowledge and capacity to control the risks. Okay, I'll stop there.
Thank you, Aaron. No discipline required. What a pity. Sure.
I remember a couple of years way back in my youth, I wrote software for a major computer supplier. One of our customers was Pearson Web Springer, who at that time were the, I think about the second largest of the reinsurance brokers on Lloyd's. And what they had a number of pools of their own, and also operated for a huge number of other private pools on Lloyd's. Right? And their problem was to make sure that they hadn't taken the same risk several times on different pools. That they didn't, you know, if they lost the hull of a plane, they didn't also have the cargo on the same pool, so it was all spread across. It's sort of, from inspection, it seems to be quite a straightforward thing to do, but actually it's very difficult calculating stuff, seeing the interrelations. Anyway, I asked a question about how they go about assessing unknowable risks in the first place, like Becky Grable's legs or whatever. There's no statistical information to go with.
Exactly.
Terrorism also falls into the same kind of category. Now, what they do in practice is to take around a slip and ask some broker, some underwriter to be the lead underwriter. And they'll say, everybody doesn't want to be the lead. Right? Eventually, somebody who's got some space on their pool will say, okay, I'll do it. Give me 2% of that risk at a premium of whatever it is, 0.25% per annum. That sets the price. Once somebody set the price, you then go into a heuristic. They take it around to other people. Oh yeah, I quite like that. He's a bit shy. I can make more if I'll take a bit more than he's taking at a slightly lower. And that's the way the competition sets up. And that goes fine for the first year. They get a feedback going on. More people come in, more Betty Grable want to insure their legs or whatever. And no, it's true, they do. Once the marketplace has been set, then you get, and eventually somebody pays out, and somebody has to, there's a loss somewhere, but you can then assess what it is. That's the way it actually works in practice. And same with terrorists, I would dispute that everything changed in 1970. I think we've been knowing about different kinds of civil insurrection or asymmetrical warfare for long, long before this. I mean, I can remember learning about this in school, about Bismarck and all that sort of stuff, with asymmetrical warfare. And that was being underwritten back then in the unification of Germany.
No, I mean, I think that you've got a great little set of data there that fits really well with a lot of the things that I was mentioning, and it's very interesting because it's like the Betty Grable's legs example is really good because it's an example from a long time ago. So yeah, so no data, sort of the pricing of the risk is something that's worked out kind of in practice in the marketplace, and then you've also pointed to some of the different difficulties with that. Kind of one difficulty when you're dealing with catastrophe, you mentioned that they didn't know about is sort of the interacting of different lines of insurance. So when you have a major catastrophe like 9/11, you can't tell how all these different lines of insurance for different things are going to be affected, and then also the way that the sort of financial risk can become obscured in the sort of chain of risk getting passed from one organization to the next. So reinsurers insure a bunch of insurance companies, and then they pass risk on to a sort of third level, even more murky level, the so-called retrocessionaires, and sometimes the risk is spread out in these complex pools in different ways that everybody completely loses track of where, what would actually happen if sort of a catastrophe comes to fruition and so on. But the key point being none of it's new. No, okay. Thanks very much.
Tom?
Just like a couple of more examples on the giving you more examples theme. One is 19th century fire insurance. Fire insurance used to be a relatively local economic organization. A fire would hit Boston, the Boston fire insurers would go broke. Fire would hit Chicago, the Chicago fire insurers would go broke. Of course, because of the catastrophic hit. That's clearly a man-made risk. And very close to home for Beck would be the Kristallnacht in Germany and the plate glass insurers. There's an excellent chapter in a book by Gerald Feldman in his History of Allianz, which you probably know about, but about the plate glass insurers who informed the Nazi regime after Kristallnacht that they were not pleased because, of course, all those Jewish businesses were insured for plate glass, and that they were, going to face a big problem. And for those who don't know, the end of that story was that the German government decided to fine the Jewish business owners in an amount that was equal to the sums that the insurance company was going to pay them for the damage, which meant that the Kristallnacht, the government took all the money, whatever. But So I'm just saying that I completely agree with this idea that the problematic nature, the sort of precarious nature of insurance, its inability to, at some level, deliver on the promise, as important as the promise is not a reason.
I mean, I'd be very interested to talk with you about a few things afterwards. I mean, those are great. I mean, I'm interested to talk with you about this sort of idea of the systemic nature of insuring things that are beyond the capacity to pay. But keen to chat with you, Tom.
This is kind of a question following with, I lived in a farming community for a decade or so. And every 6 weeks we would show up at somebody's house and we would sit down and have a game of poker. Everyone would lay whatever amount of money we chose to play with that night, whether it was $50, $100, and everyone would put that on the table and show that they had the money to play poker. And anywhere in this process, do insurance companies or are they required to show the money that they have?
So you know, and really what you're talking about is the question of regulation of the insurance industry and how much, you know, how much, the answer to that question in broad terms is sometimes, but not enough. So, yeah.
Thank you.
Sorry, behind you, Marion.
Okay. So my question is, how did this play out during Katrina? Were there a lot of claims, or how did the insurance companies respond? I mean, I understand that most people who were affected were in poor areas, so I don't even know if they had insurance or not.
Yeah.
Do you know how it?
I don't know. I mean, that's a huge story. Certainly lots of claims that should have got paid didn't get paid. You know, again, the industry's survived. You know, it took me a long time to answer this, but again, the industry survived reasonably well through Katrina. So,
Was it through reinsurance, or were they able to just pay?
well, you know, again, it's a sort of the short answer is it's a combination of both. But no, thanks, Uri.
Yeah, well, thanks, Aaron. I stopped reading Beck quite a while ago, I have to confess, and as you were speaking, I thought, why is Beck so invested in claiming that the insurance industry's alleged inability to deal with risk is somehow theoretically so, you know, significant? I mean, clearly he's wrong empirically, and clearly it's ridiculous in this day and age to try and have this binary opposition between man-made risk and natural risk. It's like, hello. But why is he making uninsurability somehow important in his theory? The more I think about it, the less I understand why.
Yeah, well, I don't know. I mean, that's a very good question. It's a question that I've sort of thought about a lot, and I don't like as I was saying, that at the end it's a bit mysterious. It's a bit mysterious to me because of the lack of kind of logic.
What's it sort of connected to?
It's the Glenbeck disease.
The Glenbeck disease. That's no, I mean, I really do. It's a mystery to me, Mariana. Like, I don't understand, other than not, you know, like, because it's not what I expected was going to happen. I expected that he would respond to our first article by saying, you know what, you're right, and, you know, anyway, this whole question of insurability isn't really that important to the rest of what I'm saying, and kind of move on. But anyway.
If I can just usurp the chair's role for a split second, I thought the reason why he was so focused on insurance was precisely his original argument about the calculability of risk versus the incalculability of post-risk. And so the insurance, the model of private insurance, and his, as you obviously have argued, perhaps wrong vision that insurance always worked through precise actuarial calculation, for him became the kind of pivotal issue because it demonstrated that we had moved out of the age of calculable risk.
Yeah. But
it's wrong on both
But yeah, I mean, so I maybe modify what I'm saying slightly, yeah, so the calculability question, I mean, because anybody who studies these risks knows that the kind of risks that he's talking about just aren't very calculable, either now or historically.
We solved this way back in the 30s with quantum mechanics, with the sum over all actions. And that resolves all these infinities. It's a gather. Everybody can, we've been using it for 70, 80 years.
So I'm not sure where we are with the chain of
Bruce.
Hi, Bruce.
Nice to see you. Sorry, I missed the first part of your talk. I just have a very minor comment to make. As a young fellow, about 1970, I trod the floors of the old Lloyd's building as an underwriter, carrying my slips around, underwriting things like Telstar communication satellite. And one of the interesting things I remember was the concept of probable maximum loss.
Right.
Have you encountered that phrase from Lloyd's?
Oh yeah, no. I mean, so that's very common in the talk of all these different kinds of risks, and then you know the sort of problematic word in that three-word phrase is of course the probable part, because you're really not able to do any kind of serious probabilistic calculations about it. So even that little term kind of confirms that it's really this sort of construction of.
And let me just add, and the truth of it was that most of these guys just thought about it for a couple of minutes.
Well, yeah, I mean, I don't want to be completely dismissive about it, and I think there's other kinds of fairly sophisticated processes going on to do with modeling and so on, but at a certain level, it's sophisticated talk and presentation about these risks rather than
just a minor ethnographic detail for you.
No, thanks, Bruce.
Tom.
This is also sort of, I try to figure out that, is I think he thinks, I think what he knows about insurance he read from Francois Yvon. And Francois made that
right
hard distinction between, risk is probable, insurance is about risk, and because that's the one, I think that's for the first book, I remember sort of cites Francois.
Yeah, and so
he just sort of locked in on that.
Yeah, so he's taken this kind, like, because when Yvon was writing, he's writing about very different kinds of risks, like, for example, life insurance, where you can much more successfully use actuarial tables, so less successfully than it's.
Well, but that's why uncertain business just blows that out of the water.
Yeah, well. No, yeah, but I mean, it's this slippage from and as you know, like from all your own work. I mean, it's partly this tendency that people have to conflate different lines of insurance. So they think, well, life insurance works in this one particular way, therefore all insurance works in that particular way.
Yeah. No, but you guys showed that not even life insurance works.
Well, less than claim, but I wouldn't sort of make. I wouldn't say at the same time that. I mean, I would, it's partly this thing about sort of realism versus kind of soft constructionism. Like there's like I would still make the claim that life insurance is somewhat more calculable than these other kinds of risks. Other people here we might get into a debate about this kind of stuff.
Well, we've got time for one last question.
Just to point out that I think Beck is not actually that invested in insurance as such, I think. He's more invested in the grand theory, as you said, the first modernity thing. So I was kind of struck, because I've read a lot of Beck, but not so much of the recent stuff, except the cosmopolitanism stuff. And I'm always confused as to where he dates the second modernity. At first I thought it was Second World War. Then I thought it was 1989, the fall of the Berlin Wall. I mean, you said 1970.
Yeah, no, and the 1970, like I won't get into. I won't try to defend that as a kind of accurate summary of where, but no, I agree with you, Tom. That
at that level, and
yeah.
Saying, well, actually, you could date this so-called second modern. Either the distinction is bogus, or you could date it.
Yeah.
Even like late 19th century.
Yeah, it was sort of 1906 San Francisco earthquake, which had many of the. Yeah, but I mean, I think you could probably, if you worked at it, push it quite a bit further back than that even. Okay, no, thanks. Thanks, Tom.
Okay, thank you very much, Aaron.
Okay, no, thanks.